Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 13. Expected returns on two stocks for particular market returns are given in the following table. Market return 7% and 25%, aggressive and defensive. These are the two stocks. 4% 40 and 9% and 18. First thing, the beta of two stocks are given. Here we can use the simple regression method or the covariance divided by variance approach. In any of the methods you will get the same results. Probabilities are not given, so simple regression method also will works. Since there are only two stocks here and then two possibilities here, direct comparisons also will give us the same results, which is nothing but aggressive difference is 36, 40 minus 4, and market returns is 25 minus 7, so which will be 2. 36 divided by 18, 2. And in case of defensive stock, 18 minus 9, 9, then 25 minus 7, 18, so which will give us 0.5. so beta is nothing but the sensitivity of the stock towards the market return. So as we can clearly see, the increase in aggressive stock is 36% and increase in market return is 18% and increase in defensive is 9%. As we can see here, if market return is increasing 18%, aggressive is increasing 36%, which is 2 times. And in case of defensive, if market return is increasing 18%, defensive is increasing 0.5 times, which is the sensitivity, right? So since only two variables are there, the direct comparison will give us the beta, or we can use the other approaches also. So the beta for aggressive is 2 and then the defensive stock is 0.5. Now the second requirement is expected return of each stock if the market return is equally likely to be 7% or 25%. Here the point to be noted is it is equally likely, so which is nothing but equal weightage given for the expected return calculation. So the simple average also works here as it is equally weighted. So simple average is nothing but 40 plus 4 divided by 2 and 18 plus 8 9 divided by 2 and 25 plus 7 divided by 2, or the weights also. Here the aggressive stocks expected return is 22, defensive stocks is 13.5. The security market line, if the risk-free rate is 7.5 and market return is equally likely to be 7% or 25, here also equally likely, so equal weightage has to be given, and equal weightage has to be given for market expected return on market portfolio. So 16%, we can directly do it by 25 plus 7 divided by 2 also, which will give us the same percentage. Now what is this SML? Considering risk-free return of 7.5%, SML is nothing but the security market line, so which is same like our characteristics line, but characteristic line is the relationship between the stock and the market return. Here the relationship is more towards the beta, so we need the SML will be nothing but SML required return is nothing but the same CAPM formula, risk-free return plus risk premium, which is nothing but beta multiplied by required market return minus the risk-free return. Here the beta will be the variable and other things being constant. So SML also is same like a characteristic line where I told, which is helpful in graphical representations of the beta towards the securities. Now going to the solution, we need, they have given the risk free return as 7.5 and we need the risk premium, market risk premium, so which is nothing but 16 minus 16 is the expected return, so expected market return minus the risk free return 7.5, which will give us the 8.5 return. Now 7.5 plus beta being variable multiplied by 8.5 percentage will give us the SML, which is security market line. Now if we plot it in the market return, if we plot it in a graph, then we can see how the stock will vary based on the beta, which will be the systematic risk, right? So it represents the expected return for any given level of risk, assuming the market is in equilibrium, and market return as we are considering 8.5. Now going to the fourth requirement, the alpha of two stocks. So alpha can be found out by alpha equal to the actual return minus the expected return on market portfolio, which is nothing but, in our case, actual return is the aggressive or the defensive returns expected return minus beta into market return, expected market return, so which will give us the alpha. So for aggressive return is negative 10% and for defensive return it is 5.5%. Thank you.